Welcome back to channel, boy. Today I'm going to cover stock splits and what that means for you as an options trader. What is a stock split and how does it occur? Well, the stock split is when the shareholders of a company decide that they need to increase or decrease the liquidity pool of their underlying stock. So essentially, you can do a reverse split, which means your stock is underperforming and it may have fallen down to $1 to $2 and it's not in compliance with the New York Stock Exchange or just within the company's standards. So what they will do is they will decrease the share pool possibly by 2 to 1, 4 to 1, 5 to 1, 10 to 1, and increase the value per share while decreasing the amount of shares. Where a stock split, like Tesla, Amazon stocks that naturally are just performing very well, may increase to a very high value per share, and they will do a stock split 10 to 1, where they will take their $800 stock and bring it down to $80. So investors can continue to buy at a reasonable price while they add more liquidity into their stock pool. Stock splits are not like printing money. It's not like you're adding to with no fundamental or like backing from the company, right? So it's like if you took $100 bill, this is bang, bang, fresh, crispy Benjamin right here, right? And you have the $100 bill, and this is my stock. This is one stock. It's essentially like cutting that $100 bill up into 10 tens, and now you have 10 $10 bills. You have 10 shares if it did a 10 to 1 split, right? So now you have 10 $10 bills. It's still the same value. You still have $100 worth of the stock, but instead of one share, you have 10 shares now of $10. And now it allows that company to grow back into the $100 stock, and now your 10 shares are worth $100. And if it does another 10 to 1, congratulations. Now you have 100 $10 bills instead of that $100 bill. And that's the power of a stock split. Over time, it adds to your shares. It's a good thing for long-term investors. So that's probably the easiest way I could break it down for you, like a stock split. How does a stock split affect options contracts? This is very important for options buyers and sellers to know. So when there is a stock split, you will have notice as a shareholder or an options holder prior to the date. When you hold an options contract through a split, your options contract becomes what's called a contract type 1. That one type options contract cannot be you cannot buy more of them. You cannot roll them. You can only close the position. And so when you get put in that awkwardness of I can't buy, I can't roll, I can only close, it could affect your options contract. Also, most splits, if you do a 10 to 1 split, your options contract also is supposed to technically do a 10 to 1 split. And this could affect the premium. Most stocks that split don't have the options chain available for 24 to 48 hours after the fact. So for me as an options trader, it's never good to be stuck in a stock where you lose total control over your options contract. It's best for me practice to close prior to a stock split, assess the stock split, see what the news, the reaction is from the trading, from the liquidity pool that they've created, and then jump back in if it's a stock that you're really interested in continuing investing options in. So one thing that you must know when a stock split occurs as an options trader is you can no longer buy more of those contracts and you can no longer roll those contracts. You are stuck with a options 1 contract. Oh, absolutely. You can definitely know beforehand when a stock split's coming. So as an investor in any underlying stock, the shareholder, they are required to disclose to you that they are going to split on a certain date. You can also check the company's websites for information like this. You can use any Twitter, a news source. A lot of these big companies, when they announce a stock split, it's known, right? Like, so a big one like Amazon, Tesla, Google, Apple, Nvidia, they've all done stock splits in the last 2 years, and it becomes an event. It becomes a high importance event in the market because it's going to be like when we talk about the advantages or disadvantages, it's going to be one of those advantages for a lot of retail traders. And I'll explain to you why here shortly. Options traders can adapt to stock splits. It's as simple as knowing the stock split date or the reverse split date and waiting for the options chain to fully update and the new liquidity that the underlying stocks pool has created. You'll start to notice a trend very quickly post reverse or stock split. You'll start to notice if the stock is still overvalued or undervalued, and it'll continue its trend. A lot of the advantages for stock splits create what I would consider, of my 5 years of trading, my opinion, you usually see a nice uptrend after a stock split, but it could obviously go down as well. As if you're going to adapt to a stock split as an options trader, the most important thing to do is to wait for the options chain to fully transfer over as well, and the premiums to calm down about, because that's a big company event. And with a large company event has what? It has a large implied volatility, because this is a big thing for the company. So when these big ticket items like a stock split happens, you're going to notice elevated IV. When the implied volatility is so high on a company due to an event like this, as an options buyer, you can find yourself in some trouble if you don't fully wait for the stock split to occur, the options chain to adjust, and for the implied volatility to drop back down. As an options seller, doesn't matter, we can make premium on this bad boy no matter what, but you don't want to get stuck in that type 1 options contract. So it's best to wait, be patient, let the options chain fully adapt into the new liquidity pool, let the implied volatility drop, and then you attack like a sniper. Yes, there's a ton of advantages for a stock split for retail investors and options traders. One of the biggest one is it makes the stock a reasonable price, right? Like when we were all trading Tesla at $800 and the options contracts were thousands of dollars, when Tesla did an 8 to 1 split and came down to $150, this makes Tesla, the actual shares and the options contracts, a lot more reasonably priced for the retail trader. So that is one of the benefits of a stock split, is the new pricing that comes once the options chain adjusts. It's very reasonably priced compared to what it was. It should be a direct ratio. So if you're paying $1,000 for one Tesla contract, call or put, previous split, now you're only paying $150 for that same contract. So it definitely adds that level of attraction to the retail options buyer and seller when it comes to how we're able to scale in because of the new pricing. Increased liquidity is another big advantage. So when we're buyers and sellers and we're options traders, right? How many times has an options buyer, how many times have you bought a trade and the bid and ask was so wide because of the lack of volume and liquidity that you had a hard time exiting that trade? Well, a split gives liquidity. It gives attraction to the retail investor. So what happens is that new high level of liquidity post split allows you for buying and selling your contracts at a much smoother and better fill for your bid ask. So that's one of the major advantages as an options trader when a stock splits, the liquidity that enters into the stock. It renews interest in a company as well. So what do I mean by that? Like if we have a stock that was hot for a long time and it's no longer that hot guy on the block, it's kind of been pushed off to the side. Well, like Nvidia did its split recently, and now Nvidia is probably the hottest stock of 2023. It is blowing up and people are flooding to it. And why is that? It's because it dropped down to a reasonable price. It pulled back with the rest of the market in the 2022 decline, and now it is such a hot commodity. But 3 or 4 years ago, Nvidia really wasn't the top guy. It was all about FANG, right? Your Apple, your Amazon, your Netflix. But now these semiconductors post-split have really taken a front seat in the market, and that's because of the split that it did. If it didn't do that, it would still be too high priced, and it wouldn't have so much retail investor attraction. One of the last things that is a huge advantage for retail investors is simply long-term holding in your portfolios, whether it's your 401k, your IRA, or leap calls as an options trader, taking 2-3 year call options contracts on an underlying stock. When Walmart IPO'd, if you were to own 100 shares of it, after its 10, 11, 12 splits, you would have 200,000 shares of Walmart. 200,000. You know how many options contracts you can sell on that? 2,000 Walmart call options a week. You could live forever comfortably knowing that you can do that. So if you were to invest in a new hot top company and that you think is going to split 10, 12 times over the next 20 years, in 20 years, you'll be able to sell thousands of call options contracts against that underlying stock and collect a massive paycheck week or month over month, quarter over quarter, whatever it may be, and create a financial level of success that you've never seen before. So stock splits in the long term, increasing that liquidity pool, I always see that as, damn, if I buy into AMD now and in 20 years AMD splits 5 more times, I could probably have 10,000 shares of AMD for the price of 100 or 200 now. And I could sell 100 call options contracts in 20 years. My kids probably won't have to work. So that's how my mind works. And I think that's one of the biggest advantages of a stock split. Many advantages as there are of a stock split, there's also a shit ton of disadvantages. And it's important you know the risks of a stock split, right? Why is the stock splitting? And reverse split, is usually because the stock has underperformed and may come into some regulatory laws or legal repercussions, or it's not up to, the requirement that some of the exchanges require. And if you come into that issue, that's starting to question the fundamentals of the underlying stock. So if you see a reverse split on a company, you really have to start questioning the fundamentals of that underlying stock and what that means for you as a trader. If you're in call options contracts and a stock is announcing a reverse split, that's a sign that things aren't going as great for the company and it's been on a significant downtrend. Regulatory laws and compliance issues as well may arise with that company. And for me, that's a fundamental red flag. I do not want to fucking be in a company that has fundamental red flags, especially for the long term. Because if you're just going to burn money, go buy a boat. Or do something else, or fucking donate it, because burning money and dealing with those kind of issues is a huge disadvantage to a stock split. Another disadvantage to a stock split is there was an old saying that if you have a piece of pizza, if you have a whole pie of pizza, and you slice that pizza 5 times, 10 times, or 20 times, it doesn't matter if the pizza tastes like shit. So if the pizza tastes like shit, if the stock is kind of shitty, it's underperforming, it doesn't have the fundamentals and the long-term outlook that you want as an investor, or the volatility and the liquidity that you want as an options trader, then if you go back in for the second bite, it's not going to taste any better. So it's best that when you have a company that's splitting, but it doesn't really have the appeal and the liquidity and the option and the interest, all the advantages coming to it, then it's best to just leave that one alone, let it adjust, and then track it for a little while, but don't really dive back in for that second bite, because if it didn't work pre-split, it's not going to work post-split for you. One of the big disadvantages that a lot of people see about stock splits is that it attracts the wrong group of investors. What does that mean, right? So does that mean that people don't want the little fish, investing into them? They don't want 1 million retail investors buying 100 stocks? Yes, that's exactly what it means. Let's take a look at Warren Buffett's Berkshire Hathaway Class A. It has never split. It costs hundreds of thousands of dollars. And it is like a bragging wealth privilege to say, yes, I own a share of Berkshire Class A. It is not the low-level investor. He keeps his investor pool small and his stock price high because he wants quality investors in his company, investors that have proven levels of success that they can afford his stock. And I think that is pretty interesting in a neat way. The fucking Oracle of Omaha doesn't believe in stock splits, and he's known as the greatest investor of all time. So that kind of brings the question, why? Why does he not like stock splits? Because he sees them as a major disadvantage to his company and to the investor pool that brings in. So there's something you should always remember in the back of your head when you're looking at a stock split as an options trader. Warren Buffett doesn't like these. So maybe I should take a step back and I should view the bigger project as it happens, the huge event, liquidity event for that company, and then I can make my best assessment after the fact. Because if the big dogs don't like it, I don't fucking like it either. You know what I mean? So you follow the money. You don't let the money follow you. Yes, absolutely. You can buy fractional shares of a stock. So if you only have 25 bucks and you want to buy 25 bucks worth of Apple, you can buy fractional shares 100%. It's a great strategy for dividend investors who want to get started slow and small and consistent. And the SP 500, right? Like the Vanguard or the Spider, those are expensive underlying stocks that you want to buy. It's the best stock that you could probably buy long term. The SP 500 has proven gains year over year over year over year. So if you don't have $300-400 to buy that stock, you could fractionally enter post or pre-split $100, and over the course of a month buy you one share. But being consistent and waiting for those splits, if you have the discipline to buy those stocks while you have a fractional share of them, that 1, 2, right? When it splits, now you will have 10 to 20 and it's going to equal out over time for you. So it's a wonderful thing by being able to scale in pre and post split with fractional shares or any shares. Same thing with options trades. To manage the risk on a stock split is so important, especially as an options trader, because you see a lot of options traders that hold their options contracts split. They may have a few weeks on it, but once it becomes that type 1, right, it becomes very tricky for the brokers and the new options chain to adjust these. You'll notice a lot of brokers have issues when they do a split on a stock. They have a hard time transferring it over, and it may take a week or 2 weeks for them to adjust everything to the appropriate levels. I've even seen occasions where options type 1 contracts went under and literally lost all of their value over the course of a few weeks because the stock split was not such a smooth transition. You'll notice that you'll see a bunch of numbers and items on your brokerage are wrong as well. So dealing with brokerage issues, dealing with stock splits and the options contracts being brought down to a type 1, I feel like the best risk management you could have is to simply not be in an options trade during a stock split or pre or post split. Why not wait? Take your profit, take your loss, whatever it is, let the big liquidity event happen, let the implied volatility drop, and jump back in with proper risk management like you're supposed to. There's advantages and disadvantages, of course. If the stock goes up 50% after the big liquidity event, then congratulations. If you were in call options, you did well. But most of the time, your broker is still going to have a hard time keeping up and adjusting to the new options train. It's going to take a few days. And if I don't have control over my swing trade or over my options, then I am doing a poor job as an options trader. You need to have the risk management in place. You need to have control and have your fucking options contract by the balls all the time. You cannot let it go or else it's going to run off and you're going to lose. So having risk management, knowing when these big events are happening and understanding how they affect your options contracts are so important. If you don't understand, watch this video again until you do. This is absolutely thrown into the category like an earnings report. An earnings report, there's 4 of them a year. Every quarter they have to report. The stock split usually happens on a good stock every few years to 10 years. And on an underperforming stock, a reverse split could be as bad as every year or every 2 years to stay in compliance, right? So having and understanding these big events, like if you think of an earnings report as such a major event, we know every single earnings report that's coming out for the next years. I know what the date is. They have to report it every quarter. A stock split is a huge liquidity event that you don't know when it's going to happen until maybe 2 weeks prior, maybe a week prior, because once the shareholders and the board vote on it, it's like that. And you get the notice and you have to act. So you have to be paying attention and you have to understand that if you think an ER report 4 times a year is a big event, a stock split should be treated like a very significant high importance event. Knowing stock splits and being an options trader is just one piece of the puzzle. And if you want to see the greater piece of the puzzle, if you want to really put it together, I suggest you come check us out at Max Options Trading, where we teach items just like this so you can be a consistent and profitable options trader. Hold on. I want to tell you a story real quick of what happened to me on the boat this weekend. So I get motion sickness. So every time I go fishing, I take Dramamine. So I'm a big guy, right? 6 foot fucking something, 300 pounds. So I'm like, fuck it. I'm taking 4 of them instead of the recommended dosage of 1 to 2. 30 minutes onto the boat, I start spinning. I'm like, oh my God, I feel nauseous. I can't believe I'm having such bad motion sickness. An hour into the boat, I am literally hallucinating. I am fucking spinning out of my mind. I don't know what's going on. I go grab the Dramamine packs to make sure she didn't drug me. And I look, and right on the front, 2 big letters, PM, do not take during day. And I went unconscious on the boat for 7 straight hours. It was not a good moment for Max.